Let us start our session. Today we are at book summary 7. Our target is to complete 200 book summaries with implementing actions. Who we are Leader Lifestyle Hub, a unique place for digital leaders to enhance every day. Let us see the book summary of the day. Today we are at book summary 7. The name of the book that we have today is Stocks for the Long Run, written by Jeremy Siegel. Without any delay, let us continue. Small information about the author, Jeremy Siegel. Jeremy Siegel is a world-renowned expert on the economy and financial markets. The author of award-winning investment classic Stocks for the Long Run. Now it's a third edition. He recently expanded that book's idea in The Future of Investors, Why the Trade and the True Triumph over the Bold and the New. Let us see the targeted audience. The 26-year-old who managed to save some money and who wants to learn how to invest it early. And the 22-year-old finance student who wants to expand his knowledge in the field, stocks field. The 45-year-old person who has money in the market and wants to learn how to adjust their portfolio to withstand a crisis. Let us see the synopsis of the book. Stocks for the Long Run delves into the subject of investing and the implications that come with picking securities, whether they are stocks, bonds, or commodities, having in mind the generally higher returns of stocks over the years and how to build a balanced portfolio that can face times of crisis. The economy is an ever-evolving mechanism that changes a lot throughout the time. People have been making money from all sorts of activities, from work to politics, and recently from investing in stocks. The stock market is a very volatile environment. Remember this, the stock market is a very volatile environment. It has the power to turn hundreds of dollars into thousands and the thousands of dollars into millions in fraction of seconds. In the short run, however, stock returns are very volatile. It will be very changing time to time, driven by changes in earnings, interest rates, risk, and uncertainty, as well as psychological factors such as optimism and pessimism, as well as fear and greed. This was said by Jeremy J. Siegel. And this book provides a portrait of the stock market with the strategies, tools, and techniques investors need to maintain their focus and achieve meaningful stock returns over time. However, with a high return comes high risk. If you are expecting high returns, then it should be higher risk. In this case, it's the risk of losing all your savings on the back of one poor decision. Therefore, one must pick their stocks very wisely and consider all variables before placing a trade. For this reason, Stocks for the Long Run, written by Jeremy J. Siegel, explores how can we make wise investment decisions, pick winning stocks, and focus on the long-term rewards in the stock market. Let us see the review of this book. This book is a must-read for everyone who wants to take charge of their finances and become a good investor. The book comprises information that serves all beginner and intermediate investors as it explains the basic principles of investing in securities on the money market, but also information on how to trade successfully and find winning stocks. If you are ready to put your savings to work, invest in stocks, learn more about finance, and become a better money manager, then this book is for you. History proves that stocks average a higher annual return than bonds over the past 10 years. In the last 60 years, and even more prominently after 2011, last 10 years, stocks have been rising at a remarkable pace. This phenomenon turned investors into millionaires in a relatively short time frame. This is a result of a balanced portfolio, good investment management, and the time in the market. Let us see the top 3 lessons from this book. First lesson, although they are generally considered riskier investments, stocks can prove to be less risky than bonds. The price of stocks does not necessarily reflect their intrinsic value. And the third lesson is ETFs and value stocks are among the best investment opportunities. Before going further, let me share a small experience that I had yesterday. I have worked on stock market knowledge with my friend. We was discussing, one of my friend named Dastgiri explained about the intrinsic value. So he gave me proper example of intrinsic value and extrinsic value. Have you ever purchased the Lays packet? I think so. You have purchased in the Lays packet or any chips packet. You see there is content of chips and there will be some air. So the chips content is known as intrinsic value, and whereas the air value is nothing but extrinsic value. You can also relate this intrinsic value. I will showcase that in the end of the book summary. Now let us take a look at each of these lessons and see what they have to offer. Lesson number 1, stocks may not be as risky as they seem if you give the market sufficient time to prove their worth. In finance and economics, there is a universal conception that bonds are safer investments than stocks. If you look at them from a volatility ratio perspective, stocks will definitely fluctuate more than bonds with no promise to deliver returns. In contrast to that, they can even wipe out your life savings if you are not careful. Means if you are careful, you will have huge returns. If you don't care about the savings, you can even that life savings will be wiped out. However, there are many factors to consider when investing in stocks over bonds. To start with, they have proven to be better investments over prolonged time frames, delivering higher returns than bonds after inflation. Given a period of 20 years, Siegel suggests that any decent company will deliver positive returns for its investors. Essentially, bonds are less volatile, but they deliver fewer profits over time, while sometimes they even can't keep up with inflation. Like corona has came or inflation might occur again. That's because bonds move according to the interest rate, which sometimes does not work in the investor's favor. As you as an investor, bonds will not work as per the profit favor. Let us take 1946 to 2001 time frame. During this period, stocks have produced an average return of 6.6 to 8%, and a gold that many people purchase has 0 to 1% return. Meanwhile, bonds had an annual real return of -2 to 8%. Moreover, the data does not include the average dividend rate of 4 to 6% annually. Although it seems that stocks have more ups and downs, they are definitely less risky than bonds. That's because other securities cannot always keep up with the inflation rate, let alone deliver a positive return for investors. Isn't placing a possible winning trade less risky than placing an undeniable losing one? Ask yourself, is it possibly a winning trade less risky, or is it placing an undeniable losing one? Let us see the lesson number 1. Lesson number 2. Stocks are not always priced according to their underlying value. Stocks are not always priced according to their underlying value. The market is an efficient mechanism for placing trades and finding stocks for all sorts. However, when it comes to the price of stocks, it may not always show the true value of a security. Investors have a tendency to switch from over optimism to exaggerated pessimism, thus the volatility of this industry. As such, an instrument has an intrinsic value given by the value of the company, which yesterday he called as a chips in the Lays packet. Revenue, management effectiveness, profit margin, cash flow, and many other aspects include in the intrinsic value, and the value of its stock price, which does not necessarily reflect the first. means the air value. A company listed on the stock exchange is rarely properly valued, and it is the investor's job to determine whether a stock is worth buying or currently undervalued. Stocks fluctuate for numerous reasons. Siegel suggests that the noisy market hypothesis is a good potential explanation for this. It states that stocks are being pushed away from their real prices by investors trading for unrelated purposes. This include tax harvesting, like you harvest the seeds in the garden, there is a tax harvesting, rebalancing portfolios, cutting losses, taking profits, and so on. One is better off keeping their money invested in the long run instead of panic selling in times of losses. Remember this, it is better to keep money invested in the long run instead of panic selling in the times of losses. Let us see the third lesson. Keep your money invested in ETFs and find value stocks. ETF stands for Exchange Traded Fund. This was the main lesson that I learned from my friend yesterday after spending 1 hour. Exchange Traded Fund. It is a security that tracks an index, a commodity like gold or silver, or an industry. It also tracks other options, other types of assets. This security trades like a stock and is publicly bought and sold on a stock exchange, just like other regular shares. The main advantages of such a security is its ability to withstand a market pullback while also delivering remarkable returns for investors. For example, let us take an example. By investing in an ETF, exchange traded fund, tracking an index made of companies such as the famous S&P 500, you don't just buy the shares of one company, but a small fraction of all 500 companies from the index. You can buy and sell an ETF during the market hours, just like you buy a stock and expect it to replicate the index perfectly without you worrying about anything. Another type of investment the author prizes is the value stock. Unlike a growth stock, which many expect to beat the market and grow exponentially, deliver remarkable results, and usually overvalued, so it presents a great risk. A value stock has other attributes. It is a stock of companies that have not yet been discovered, have strong and promising figures, stable management effectiveness, and growth over the years, and most importantly, trade under their fair price. Finding a value stock can be a challenging one. It is a very challenging task to find a value stock, especially with so all the funds and retail investors keeping an eye on the markets 24/7. You may think that there is no way to discover a value stock before it becomes a mainstream. But if you look around for your favorite shop, service providers, promising businesses, or simply find companies that are publicly traded and look up their numbers, you had be surprised of how much valuable information you can find. Yesterday, I found one resource which is very powerful and useful for finding intrinsic value of the company as well as extrinsic value of the company. Let me share that resource with you. You can also do the research on the stock market values if you want to go ahead. Let us go for option chain. You can do Google search. You can find out lots of things on that. Do research on this as an action task of this book summary. Option chain, in this option chain in the NSE India, National Stock Exchange of India, you will see that option chain. In that option chain, you will see all the indexes where you will find the intrinsic value as well as extrinsic value, so that you can decide which stock you need to address and which stock you need to ignore. So this is the important lesson that you can take away from one of my friends shared this. And let me recap the entire 3 lessons from this book, Stocks for the Long Run, written by Jeremy Siegel with the help of mind map. Stocks for the long run. about Jeremy Siegel. Jeremy Siegel is a world-renowned expert on the economy and financial markets. The author of the award-winning investment classic, The Stocks for the Long Run. The professor in the financial department at Wharton for 40 years. Jeremy Siegel is an assistant professor of business economics from the University of Chicago. Let us see the targeted audience again, who want to manage their earnings and who want to learn how to invest early. The finance student who wants to expand their knowledge in the stocks field, for them, this book is the Bible. Who has the money in the market and wants to learn how to adjust their portfolio to withstand their crisis, again, for them, this is the book for them. Let us see the top lessons again. Although there are generally considered riskier investments, stocks can prove to be less risky than the government bonds. Stocks are very less risky than bonds. The price of stocks does not necessarily reflect their intrinsic value. ETF, exchange traded funds and value stocks are among the best investment opportunities. Do small research on ETF and value stocks today. Stocks are not always priced according to their underlying value. Keep your money invested in ETFs and find value stocks. Stocks may not be as risky as they seem in the market if you give the market sufficient time to prove their worth. And always remember, stocks is a game of emotions. And if you have that knowledge of emotions game, you will easily earn and become millionaire from the investor level. That's what today's book summary is. See you in another book summary another day. Until then, keep progressing, stay connected.